Hey everyone, today we're going to talk about the latest service sector PMI data. The June service sector PMI, Purchasing Managers Index, fell well short of expectations, showing the fastest rate of contraction in 4 years. According to data from the Institute for Supply Management, the service sector PMI dropped to 48.8 in June, much lower than the expected 52.6 and significantly down from 53.8 in May. This figure not only missed all economists' predictions but also stands in stark contrast to May's notable expansion, when the service sector PMI hit 53.8, the fastest growth in 9 months, well above the expected 51. So, what are the key sub-indices telling us? Business Activity Index, it plunged by 11.6 points to 49.6 in June, marking the biggest drop since April 2020. This indicates that business activity has entered a contraction phase, reaching its lowest level since May 2020. In ISM manufacturing data, the Business Activity Index corresponds to the Factory Output Subindex, showing a significant drop in service sector output. New Orders Index, this fell by 6.8 points to 47.3 in 1 month, indicating new orders have shrunk for the first time since the end of 2022. Although the Export Orders Index is still expanding, it dropped by 10.1 points to 51.7, signaling weak overseas demand. Price Index, the measure of prices paid by service providers for materials, fell to a 3-month low, dropping from 58.1 in May to 56.3 in June, reflecting gradually easing inflation pressures. Employment Index, this index shrank for the 5th consecutive month, recording 46.1 in June, down 1 point from May's 47.1, indicating the service sector job market remains weak. Inventory Index, inventory shrank at the fastest pace since October 2021. However, the Inventory Sentiment Index jumped to its highest level since 2017, suggesting more businesses feel their inventory levels are too high. Backlog of Orders Index, the backlog of orders dropped significantly in June, showing the fastest contraction since August of last year, reflecting a significant improvement in the backlog situation. So, what does this mean for the broader economy? The significant deterioration in the service sector PMI has not only negatively impacted market sentiment, but also added new pressure to the U.S. economic outlook. The ISM Manufacturing Index has contracted for the 3rd consecutive month, with overall demand under greater pressure due to high borrowing costs, cooling business investment, and uneven consumer spending. The market reacted quickly, with the yield on the 10-year Treasury note dropping significantly, providing some support. Meanwhile, the June non-farm payroll data is set to be released soon, and the market is closely watching this data for clues on potential Fed rate cuts. The stock market has been rising steadily this week, reflecting optimistic market sentiment. Justin, the chief investment officer at St. James Place, commented, with the June ISM service sector PMI dropping to 48.8, the lowest since the pandemic, coupled with worsening jobless claims data, the negative data might ultimately be seen as positive for the market. Everyone is now focused on September. This unexpected data will have significant implications for economic policy in the coming months. Investors and policymakers need to closely monitor the development of subsequent economic data.